Imagine a machine so powerful that it basically breaks the traditional rules of physics to solve problems standard supercomputers can't even touch.
We're talking about things like optimizing entire national energy grids to prevent blackouts.
Right. Or, figuring out global logistics for a massive shipping giant in literally seconds. That is the promise of quantum computing. Now, imagine trying to put a fair price tag on the company building that machine using Warren Buffett's rigid, old-school financial principles.
It's the ultimate clash of eras, really. I mean, you have the Oracle of Omaha philosophy on one side, demanding cash flow, clear moats, predictability.
And on the other side, you have quantum mechanics.
Exactly, where particles exist in two states at once, and the profits, well, they might be entirely theoretical until maybe 2035.
It's a massive paradox. And that is exactly where we are living today. Welcome to the Deep Dive. Today is February 21, 2026, and we are cracking open a deep research report dated for tomorrow, February 22.
Getting a head start.
You know it. We're analyzing D-Wave Quantum Inc., ticker symbol QBTS.
And this isn't just a tech story, it's really a finance story about survival. The central tension we're unpacking today is whether you can even apply value investing to a speculative, pre-profit firm.
Or if the old rules simply break down when you're dealing with a paradigm shift of this magnitude.
Right.
By the end of this deep dive, you are going to have to decide if this company is the next tech giant waiting to explode.
Or just a cash incinerator.
Burning through investor money just to keep the lab lights on. We have a lot to cover today. We need to look at the machine, the management, and the money. Let's get structured.
Let's do it.
Part 1, chapters 1 to 3. Business, management, and financials.
Sounds good.
Chapter 1, business understanding.
So to really get this business model.
Wait, because when most people think of quantum computers, they picture those giant gold chandeliers hanging in a freezer that's colder than deep space.
Yeah.
Is D-Wave actually shipping those units out to customers?
No, not exactly. And that's a crucial distinction. They've adopted a model called quantum computing as a service, or QATES.
QATES, okay.
Yeah. The hardware required to run these things involves these massive dilution refrigerators running near absolute zero. It's a logistical nightmare for a regular company to maintain.
I can imagine.
So D-Wave keeps the hardware in their own labs, and they basically just sell access to it via the cloud through a platform they call Leap.
Oh, so it's like the Netflix model, but for solving impossible math problems.
Yeah.
You subscribe to the power, you don't buy the generator.
That's the core of it, yeah. But there's a second revenue stream that's really important here, which is professional services.
Because nobody knows how to use this stuff yet.
Exactly. Almost nobody knows how to write quantum code. It is not like learning Python or Java. So D-Wave charges companies to teach them.
No.
They call it D-Wave Launch. They help enterprises build custom applications, essentially selling the shovel and the lesson on how to dig.
Which makes sense because the barrier to entry is insanely high. But let's get technical for a second here. What is the actual aha moment? Why are companies paying for this service right now?
It really comes down to one word, which is optimization. Okay. Classical computers, like your laptop or even a standard supercomputer, they think in ones and zeros. They do things sequentially. So if you're trying to route 1,000 delivery trucks to avoid traffic...
A classical computer has to check every single route option one by one.
Right, which takes way too long for real-time logistics.
And D-Wave does it differently.
Completely differently. They use something called quantum annealing. Their qubits use superposition to find the lowest energy state of a problem instantly.
Lowest energy state.
Yeah, the best analogy is water flowing down a hill.
Okay.
Water doesn't check every single rock and crevice to decide where to go, right? It just naturally, instantly finds the lowest point.
Oh, that makes total sense.
That is what D-Wave's annealing tech does for massive data sets. It's being used right now for defense threat analysis, scheduling airline crews, even autonomous vehicle routing.
Okay, so they have a product that actually works for optimization.
Yeah.
But looking at the timeline from the report, they made a massive move in January of this year, 2026.
The acquisition.
Yeah, they acquired Quantum Circuits, Inc. for $550 million. Why spend $500 million if their annealing tech is already working so well?
Well, this was the pivot, and frankly, it was a survival pivot. See, annealing is great for optimization, but it's limited. It cannot solve every type of problem.
Got it.
The real holy grail of the industry is gate model computing. That's the general purpose stuff using logic gates like A and D, OR, and NOT that can theoretically run any algorithm.
They needed that capability.
Exactly. By buying quantum circuits, D-Wave became a dual platform player. They have annealing for revenue today and gate model for the future.
And that acquisition brought in a specific technology called dual rail qubits. Can you break that down? I mean, is that just marketing speak or is that real?
No, it's actually a really significant engineering leap. One of the biggest problems in quantum computing is error rates. These qubits are incredibly fragile. A slight temperature change ruins the whole calculation.
Just totally corrupts the data.
Right, so dual rail means they use two physical qubits to represent a single logical qubit. It allows for built-in error detection. If the two physical qubits don't agree, the system knows there's an error.
Wow, so it's a massive step toward actual reliability.
It is.
So they aren't just betting on one horse anymore. Where does that leave them in the competitive landscape?
They are commercial ready, which is very rare in this space.
Yeah.
While competitors like IonQ or Getty are often just stuck in the R&D phase, D-Wave generated about $18 million in revenue just in the first half of 2025.
Wow.
Yeah, they have over 100 clients, including the Australian Department of Defense. They are selling real products, not just promises.
That sounds great on the surface, but a product is only as good as the people selling it.
Let's talk about the people.
Chapter 2. Management evaluation.
We really have to look at the captain of this ship.
Right, CEO Dr. Alan Baratz. From the outside, the strategy looks sound.
Dr. Baratz is a fascinating figure to analyze here. If you look at the strategic side, he's been brilliant. He steered that massive pivot to the dual platform model we just discussed, and he secured those government contracts.
Yeah.
He saw that annealing wasn't enough to capture the whole market, and he fixed it.
But looking at the balance sheet in this report, I'm seeing a massive trade-off here. He secured the contract, sure, but the cost of capital to get there was brutal.
You've hit the nail on the head. But here's the capital crunch. He is overseeing a company that is burning money at an alarming rate. And his response to keeping the lights on has been very controversial for shareholders.
You're talking about the dilution.
Yes. When a company is losing money, it needs cash to pay the scientists, right? So Dr. Baratz utilized at the market, or ATM offerings. They raised $175 million in 2024 and a massive $400 million in 2025.
Let's make sure everyone understands dilution here. It's like ordering a pizza for a party. You have 8 slices, but then the host decides they're hungry, so they cut the same pizza into 16 smaller slices. You still have a slice, but it's half the size it was before.
That is exactly what happened to the shareholders. D-Wave basically printed more stock to sell to the public, and while that built a huge cash stockpile of $819 million.
Which keeps them safe from bankruptcy.
True, but it diluted every existing shareholder's stake. The slice of the company you own got significantly smaller because they had to print more shares just to feed the beast.
And it seems like there's some internal friction, too. The research report mentions reviews from employees describing a culture focused on stock price rather than customer success.
That is a classic red flag in Silicon Valley. When employees feel leadership is obsessed with a buyout rather than the product, it can really rot the company from the inside.
Yeah, if the engineers are worried about the stock price instead of the qubits, innovation naturally slows down.
Exactly.
And where is all that cash actually going?
R&D and M&A. They spent $23 million on R&D just in the first half of 2025, plus that $550 million acquisition we talked about.
So they are not returning money to shareholders. No dividends, no buybacks.
None. They are reinvesting everything to try and win the race.
Which brings us to the numbers.
Yeah.
And folks, brace yourselves, because this is where the Buffett philosophy starts screaming.
It really does.
Chapter 3. Financial health.
The report literally calls these metrics a horror show.
Let's start with the good news, assuming there is some.
The good news is the gross margin. It's fantastic, sitting around 87%.
Yeah.
Since they are selling cloud access and software, it costs very little to service an additional customer. Once the machine is running, the marginal cost is incredibly low.
Okay, 87% is elite. That is pure software level margins. But then we look at the net margin, and the floor just falls out.
It doesn't just fall out, it crashes into the basement. The net margin for the first half of 2025 was negative 954%.
Hold on. Negative 954%.
Yeah.
That means for every single dollar they bring in from a customer, they are losing roughly $9 to $10 on the bottom line.
Worse, actually. In some calculations, it's up to $16 lost for every dollar gained.
That's insane.
That is because their overhead, the R&D, the scientists, the administration, it completely dwarfs their revenue. They are spending absolute fortune to make a pittance.
So the cash flow must be a disaster.
Deeply negative. They burn about $55 million in the trailing 12 months. In traditional finance terms, this is a cash incinerator.
But you mentioned they have a lot of cash in the bank.
That's the huge anomaly here. They have virtually zero debt because no bank would ever lend to a company losing this much money.
Right.
But because of those stock sales, the pizza slicing we talked about, they have an astronomical current ratio of over 54. They have a pile of $819 million in cash. They have plenty of money to survive right now, but only because they diluted the shareholders to get it.
So how do you even value a company like this? It seems impossible.
It is the valuation impossible. If you use a discounted cash flow model, which values a company based on the cash it generates.
D-Wave is worth absolutely nothing.
Exactly, because the cash flow is negative. To justify the market cap of $6.75 billion at around $18 a share, you have to assume percent hypergrowth of 46% or more annually for a decade.
But isn't that just how tech works? I mean, Amazon was unprofitable for years. Uber was unprofitable. Why is this any different?
The difference is the scale of the burn versus the growth. Amazon had massive growing cash flows from operations even when they showed a net loss. D-Wave is burning cash just to exist. You aren't investing in math here, you're investing in faith.
Faith that the physics will eventually pay the bills.
Let's see who actually has that faith.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Let's look at the market perspective.
Chapter 4, market sentiment.
So we have a company losing massive amounts of money, but holding the keys to the future of computing. What does the market actually think?
It is a completely split reality. On one side, you have the analysts, the optimists. The consensus is a strong buy. They have price targets ranging from $22 up to $48. They're looking at the technology and saying, this is the next big thing. Ignore the balance sheet for now.
But then you look at the charts, and the technicals tell a totally different story.
Right. The stock is trading below its 50-day and 200-day moving averages. That is a definitively bearish trend. The momentum is downward, meaning investors are voting with their feet and walking away.
And there's a group betting big on that downward spiral, the short sellers.
This is where it gets dangerous. About 16% of the available shares, the float, are sold short. That is a very high number. Smart money is betting the stock will crash.
But 16% short interest, doesn't that create a huge risk for the bears too?
Huge risk. It creates squeeze potential. If the stock pops on good news, say a new government contract, it would take nearly 3 days of buying volume for those shorts to cover their positions.
And that buying pressure could send the stock rocketing upward.
It's a powder keg waiting for a match. It really is a battleground. The media reflects this too. Tech blogs are cheering quantum speed, while financial blogs are screaming about astronomical cash burn.
It depends entirely on what lens you use to view the world. The engineer sees a miracle, the accountant sees a disaster.
Chapter 5, ownership structure.
Let's look at who actually owns this thing. I see huge names like Vanguard and BlackRock on the list. Does that mean they believe in the company?
You have to be really careful with that assumption. Vanguard and BlackRock are largely passive indexers. They have to own D-Wave because it's in the index, like the Russell 2000.
Right, they aren't buying it because they love Dr. Baratz or the dual-rail qubits.
They're buying it because their computer algorithms tell them they must maintain the proper weighting.
Okay, so that's not necessarily a vote of confidence. What about the people who actually run the company, the insiders?
This is where the Buffett rule kicks in. Buffett wants management to buy and hold. He wants them to have skin in the game. But at D-Wave, we are seeing massive insider selling.
Give us the details. Who is actually selling?
The CFO, John M. Markovich, sold about $4.6 million worth of stock. The EVP, Diane Nguyen, also sold significant amounts.
Let me play devil's advocate here for a second. Maybe they just need cash. Maybe they're buying a house or paying a huge tax bill.
Selling a few thousand shares is buying a boat. Selling $4.6 million worth of stock is an exit strategy. It is a major red flag. If the people who know the company best, the ones seeing the secret labs and the financial books every single day, are cashing out millions of dollars, why should you, the listener, be buying in?
That's a tough point to argue with. If they thought the stock was going to $100, they wouldn't be dumping it at $22.
Precisely. It signals a lack of confidence in the near-term price appreciation. They are taking their chips off the table.
Wow.
Chapter 6, risk assessment.
We've touched on the internal risks, but D-Wave obviously doesn't operate in a vacuum. What's happening in the macro environment that could hurt them?
We call this the gravity of finance. First, interest rates. We have sticky inflation at 2.7% and rising bond yields. When you have a company whose profits are 10 years away, High interest rates crush their value today.
Right, because investors can get a guaranteed 5% return in bonds, so why risk money on a highly speculative quantum startup?
And then there are tariffs.
Yeah.
We are in 2026, and trade wars are very real.
The 2025 tariffs are a major headache. Even though the European tariffs were recently scrapped, which does help their German supply chain, the tariffs on China remain.
And quantum computers need highly specialized components, things like those dilution refrigerators we mentioned.
Exactly. If you can't source the parts, or if they cost 20% more because of trade war, that cash burn we talked about gets even worse.
There's also the government aspect. Uncle Sam is watching.
Export controls are a double-edged sword here. The U.S. Department of Commerce restricts sending quantum tech abroad. That limits D-Wave's market. They can't just sell to anyone globally. But there's a massive opportunity here, too.
You mean the OBBB?
Yes. The One Big Beautiful Bill Act of 2025. It's a massive piece of legislation allocating billions for AI and quantum defense. D-Wave could win big here. If they can secure those government grants, it bridges the gap between their cash burn and profitability.
It's essentially free money if they qualify.
But they aren't the only ones chasing that money.
No. It's David versus Goliath. They're fighting IonQ and Rigetti, sure, but they're also fighting Google, AWS, and IBM. IBM alone has over 2,500 patents in this space.
Can D-Wave really outspend Google?
That is the existential threat. When the giants fully wake up, does D-Wave just get crushed?
That's the billion-dollar question.
Chapter 7. Conclusion.
So what does this all mean? We've looked at the tech, the money, the insiders, and the macro risks. Let's boil it all down.
The bull case is compelling if you are a technologist. D-Wave is a first mover. They have commercial revenue right now, not just in theory. They have a dual platform strategy that covers today's needs and tomorrow's dreams.
And they are swimming in a total addressable market that could be $19 billion by 2035. If they survive, they could literally own the future of computing.
But the bear case keeps staring at me from that balance sheet.
The bear case is brutal. It is a financial black hole. Margins at negative 954%. Shareholders are being diluted constantly. Insiders are actively selling their own stock. And the valuation relies entirely on faith, not math.
If the music stops and the market turns against speculative tech, this stock could easily go to zero.
It really feels like D-Wave isn't a stock in the traditional sense. It's something else entirely.
It's not an investment in a business. It's a venture capital bet. Here's the final thought I want to leave you with today. D-Wave is essentially a venture capital lottery ticket disguised as a public company.
That's a great way to put it.
You aren't investing in a business with a standard P&L. You are paying for a front-row seat to a massive science experiment. The real question is, are you willing to pay the price of admission to see if the experiment actually works?
And that is a question only you, the listener, can answer.
That's a wrap for this deep dive into D-Wave. Thanks for listening.
This analysis was generated by AI for educational purposes and should not be considered financial advice. Please do your own research before making investment decisions.